Have you ever wondered how to invest in dividend stocks? Welcome to the thrilling world of dividends where patience truly pays off. Firstly, let's unravel the mystery of dividend stocks. Simply put, they are shares in a company that regularly disperse a portion of their profits to shareholders. Imagine owning a slice of a pie and periodically you get a bit more of that delicious pie. That's essentially how dividend stocks work. Investing in dividend stocks can be quite advantageous. It's like having a regular income, a financial lifeline that keeps flowing even when the market gets choppy. Besides, there's the potential for steady growth. Over time, these stocks can increase in value, meaning your slice of the pie gets bigger. In essence, dividend stocks allow you to reap the benefits of a company's success directly, and who wouldn't want a bit of that? Understanding dividend stocks is the first step towards making informed investment decisions, so let's dive deeper. Now that you know what dividend stocks are, how do you go about investing in them? Well, the process of investing in dividend stocks can be broken down into 4 easy-to-follow steps. Firstly, research is the cornerstone of any successful investment strategy. You'll want to delve into the financial health of potential investments. Look for companies that have a history of stable earnings, strong balance sheets, and a track record of paying dividends consistently. Dividend yield, payout ratio, and dividend growth rate are key indicators that can help you assess a company's dividend potential. Secondly, you'll need to open a brokerage account. There are numerous online brokerages to choose from, each with their unique offerings. Some brokerages cater to beginners with easy-to-use interfaces and educational resources, while others may offer advanced trading tools for more experienced investors. Choose one that aligns with your needs and comfort level. Next, we move on to the actual buying of shares. Once you've decided on a company to invest in, you can use your brokerage account to purchase shares. Remember, it's generally a good strategy to start small, especially if you're new to investing. Regularly investing smaller amounts over time, a strategy known as dollar cost averaging, can help mitigate risk. Lastly, after buying shares, the journey isn't over. You'll need to monitor your investments regularly. This involves keeping abreast with your company's earnings reports, news events, and any changes in their dividend policy. Adjust your investments as necessary based on your ongoing analysis. To recap, you'll need to research potential investments, open a brokerage account, buy shares, and then monitor your investments continuously. Each step is crucial and requires careful thought and action. Remember, investing isn't a one-time activity, it's a journey. And like any journey, it requires preparation, execution, and constant vigilance. Investing in dividend stocks involves a series of steps that require careful consideration and ongoing management. Stay tuned as we delve deeper into how to choose the right dividend stocks in our next scene. So, what factors should you consider when selecting dividend stocks? Let's delve into the criteria that can guide you in making the best choices. The first criterion is the dividend yield. This is the annual dividend payment divided by the stock's current market price. You might be tempted to go for the stocks with the highest yield. However, a higher yield could indicate that the company is in trouble. As a rule of thumb, a yield that's too good to be true probably is. So look for stocks with a reasonable and sustainable yield. The second criterion is the payout ratio. This is the percentage of earnings a company pays out as dividends. If the payout ratio is too high, it may mean the company isn't reinvesting enough back into its business. Conversely, if it's too low, the company might not be sharing enough of its profits with investors. A payout ratio between 30 and 60% is generally considered healthy. Next, consider the company's financial health. Companies with strong balance sheets are more likely to maintain or increase their dividends. Look for companies with low debt, consistent earnings, and positive cash flow. Also, consider the company's dividend growth. Companies that consistently increase their dividends over time are often more reliable. This indicates they are growing, profitable, and committed to returning capital to shareholders. Lastly, don't forget the importance of diversification. Don't put all your eggs in one basket. Instead, spread your investments across different sectors and companies. This reduces the risk and increases the potential for returns. Remember, thorough research and due diligence are vital when choosing dividend stocks. Use these criteria as a guide, but also take into account the company's industry, its competitive position, and the overall economic environment. Choosing the right dividend stocks can significantly impact your investment outcomes. It's not just about picking stocks with the highest yield or the lowest payout ratio. It's about understanding the company's financial health, its growth prospects, and how it fits into your overall investment strategy. Now that you know what to look for, you're well on your way to becoming a successful dividend investor. Choosing the right dividend stocks can significantly impact your investment outcomes. As with any investment, dividend stocks come with their own set of risks. Let's delve into what these potential risks might be. First, we have market volatility. The stock market is a dynamic and ever-changing entity. Prices of stocks rise and fall based on a variety of factors that are often out of our control. This means that the value of your dividend stocks can fluctuate, and there's a chance you could lose some or all of your investment. Then there's the risk of dividend cuts. Companies aren't obligated to pay dividends, and they might reduce or completely cut their dividends in response to financial difficulties or other strategic reasons. If you're relying on dividends for income, this can be a significant blow. Moreover, there's the specter of company insolvency. If a company goes bankrupt, it probably won't be able to pay dividends anymore. Plus, shareholders are last in line when a company's assets are liquidated, meaning you might not get back your initial investment. So, these risks sound scary, right? Well, don't fret just yet. There are ways to mitigate these risks. Diversification is one of the most effective strategies. It's the old saying of don't put all your eggs in one basket. By spreading your investments across a range of companies and sectors, you can reduce the impact of any one company's poor performance on your overall portfolio. Regular portfolio review is another crucial step. Keeping an eye on your investments can help you spot any red flags in advance, such as a company consistently cutting its dividend. You can then decide whether to hold onto the stock or sell it. Finally, remember that investing in dividend stocks is a long-term game. Short-term market fluctuations are less important if you're in it for the long haul. In conclusion, yes, investing in dividend stocks does come with risks, but understanding these risks and taking steps to mitigate them can go a long way in protecting your investment. Being aware of the risks and knowing how to manage them can help you navigate the world of dividend investing more confidently. Ready to start your dividend investing journey? Here are some tips to help you succeed. First and foremost, consider reinvesting your dividends. This is a powerful tool that can significantly accelerate the growth of your investment over time. When you reinvest dividends, you're essentially purchasing additional shares of the stock at no additional cost. This increases your overall stake in the company and amplifies your future dividends, thus setting up a cycle of compounding growth. Next, focus on the long term. Dividend investing isn't a get-rich-quick scheme. It's a strategy that rewards patience and steady investment. Companies that consistently pay dividends are often established with a stable business model and a history of profitability. These are companies that are likely to continue thriving in the future. A knee-jerk reaction to short-term market fluctuations could jeopardize your long-term gains. So always keep a long-term perspective in mind. While it's important to stay patient, it's equally crucial to stay vigilant. Keep a close eye on your investments. Regularly review your portfolio and the performance of the companies you've invested in. If a company consistently cuts dividends or if their financial health deteriorates, it may be time to reconsider your investment. Lastly, don't hesitate to seek professional advice. While dividend investing can be simplified to some extent, the world of finance can be complex. A financial advisor can provide valuable insight, help you navigate through the complexities, and assist you in making informed decisions. Remember, dividend investing is not just about picking stocks with high dividend yields. It's about choosing companies that are likely to sustain those dividends and grow them over time. It's about being patient, staying committed, and constantly learning. Successful dividend investing requires a strategic approach, patience, and a commitment to learning. Investing in dividend stocks can be a rewarding way to grow your wealth. Over the course of our discussion, we've journeyed through the fundamental steps of investing, from understanding what dividends are to the criteria for choosing the right stocks. We've highlighted the importance of considering a company's financial health, its dividend yield, and its payout history. We've also navigated the risks associated with dividend investing, reminding you that not all glitters is gold in the world of stocks. It's crucial to stay vigilant, carefully weighing the potential returns against the inherent risks. On top of that, we've shared some valuable tips to help you thrive in your dividend investing journey. Patience, consistency, and continuous learning are your allies in this exciting endeavor. Remember, the key to successful investing lies in understanding your investments and making informed decisions. Happy investing.